Welcome back to the deep dive. Today, we're not just talking about insurance in general. We are really dissecting the high stakes, almost military grade precision you need to run a massive general insurance institution.
Yeah, we've compiled all the dense operational rules, the financial formulas, the regulatory ceilings that senior management has to live by day in and day out.
Think of this as getting a fast pass to the command center.
Exactly. Our sources, they reveal the exact percentages, the numerical triggers, all those critical legal clauses. It's the secret playbook, if you will, that determines massive liability and, even corporate survival.
We want to go deep on that precision. Like, why does a claim for a broken machine only get partially paid?
Or why doesn't a car owner breaking their policy rules get the insurer off the hook for a third-party claim?
And what's that exact number on a balance sheet that makes the regulator have to step in? I mean, this is a world where being off by just 1% can cost millions.
So our mission today is really to distill these crucial and sometimes surprising details. We're connecting the tiny clauses in a policy to the huge government mandates.
Okay, let's unpack this. So let's start where the rubber meets the road, the policy contract itself. The precision in that language, it feels like it's designed to manage risk, but sometimes it feels like it's designed to manage the customer's expectations right down to the last rupee.
Oh, it absolutely is. And
Yeah.
nothing shows that better than the average clause. You see this all the time in business interruption policies.
Right. And this clause is all about preventing what they call underinsurance, correct?
It's all about that. Basically, if you are underinsured, the insurer can and will punish you by cutting your claim down proportionally.
Okay, so run us through the math on that. How bad is the consequence?
It's severe. Let's use the example from our source material. So
Yeah.
a company insured its expected gross profit for, say, 80 lakh.
Okay.
But their actual gross profit for the year turned out to be 100 lakh. So they were underinsured by 20%.
All right, so then a fire shuts them down for a few months. They have a 20 lakh loss. They're not getting that full 20 lakh back, are they?
Not even close.
Yeah.
The insurer applies that 80 over 100 ratio, so the claim payment gets cut down to 16 lakh.
Wow.
Management has to get that the moment they sign. They've agreed to eat that missing 4 lakh themselves. It forces you to be incredibly accurate with your financial forecasting.
That is a brutal lesson. Okay, let's talk about something else that kills policies. Inherent vice. This sounds almost philosophical.
It does, doesn't
You wrote it.
But it's a really strategic exclusion. Inherent vice is just the risk that the thing you're insuring basically self-destructs because of its own nature.
Not because of some external event.
Exactly. Not a fire, not an accident. So in machinery breakdown policies, they explicitly exclude loss from gradual deterioration. That's not an accident. It's just inevitability.
I think the marine cargo example is the clearest one. You're picturing a huge storm at sea, but one of the biggest exclusions is just spoilage of fruit cargo due to natural ripening.
The bananas were going to ripen anyway. That risk was inherent to the goods. The insurer isn't there to guarantee the perfect shelf life of your fruit, just to cover things like a fire on the ship or a collision.
That distinction, external peril versus intrinsic doom, that's everything. And you see a similar logic with the pair and set clause in industrial policies.
This one's really interesting. It protects the insurer from paying for a subjective drop in value when only one part of a set gets damaged.
Give us the scenario.
Okay, so you have a big machine system. Component A gets damaged. It costs 50 lakh to fix. Component B is totally fine. But now the whole system just feels less valuable because it's incomplete.
Right, I can't sell it for as much on the secondary market.
But the policy says, too bad. Recovery is limited only to the cost of component A. They have zero liability for the drop in value of the undamaged component B. They only fix what actually broke.
So it's very clean. It draws a very clear line.
Very clean. It's about indemnity, not betterment.
Okay, before we move on, we have to touch on the oldest form of this stuff. General average in maritime law. It's so fascinating because it's about a deliberate sacrifice.
It's a profound concept. For general average to even be triggered, the sacrifice has to be deliberately made to preserve the entire venture.
Meaning the captain has to choose to do it?
Yes. The captain has to intentionally throw cargo overboard or cut down a mast to save the rest of the cargo and the ship itself. It's an intentional act for the greater good.
So if my cargo of coffee beans gets tossed overboard to save the ship, everyone else, the ship owner, the guy who owns the electronics cargo, they all have to chip in to pay for my loss.
That's a good way to put it, yeah. It's shared liability enforced by ancient law. Everyone contributes proportionally to the loss, so the person who made the sacrifice is made whole.
So the takeaway from this first part seems to be that contract precision forces you to be a perfect risk calculator.
It really does. If you get your gross profit wrong or don't understand the weakness of your product, the policy clauses will just automatically shift that financial pain right back onto your company.
Now let's shift gears. From the fine print of contracts to the hard stop of public safety laws, this is where the regulator just overrides the policy.
And you see this most dramatically in the motor sector. The Motor Vehicle Act, it creates this incredible layer of statutory obligation, especially for third-party liability.
It basically says, we don't care what your contract says if an innocent person gets hurt.
That's the gist of it, yes.
So let's talk about the rule that always shocks people. The pay first, recover later mandate. So a private car owner uses their car as an illegal taxi, they breach the policy, cause an accident, and there's a 5 lakh decree against them. What happens first?
The insurer's duty to that injured third party is absolute. They must pay the decree to the third party first. That person has to be compensated immediately.
And only after that can the insurer go after their own client to try and get that 5 lakh back.
Exactly. And they have to begin this complex, expensive, and honestly, often failed legal process to recover the money.
So the insurance company is basically acting as a public safety net.
In many ways, yes. They become an agent of public policy, guaranteeing compensation. It creates a real tension between, commercial risk pricing and this broader societal responsibility.
Now, that's an absolute rule, but the compensation can still be adjusted for fault, which brings us to contributory negligence.
Correct. Fault isn't always all or nothing. If a claims tribunal decides the claimant was, say, 30% responsible for the accident, maybe they ran a red light, then the compensation gets reduced by that amount.
So if the total damages were 10 lakh, that 30% fault brings the final payment down to 7 lakh.
Precisely. A mathematical allocation of blame.
Okay, let's shift to property. The definition of crime under an insurance policy. What is the super specific definition of burglary that managers need to know?
The definition is incredibly rigid. It's not just theft. The theft must follow the use of violent and forcible entry or exit from the premises.
So if the thief just tricks an employee into opening the door or finds a window unlocked.
That's not forcible entry. That would be symbol theft or theft by trickery,
Yeah.
and that's often excluded from a burglary policy.
So your security protocols become just as important as the lock on the door.
Absolutely. The policy is covering a physical attack on the building, not a failure of your internal procedures.
Now for health insurance. A huge consumer protection rule. The moratorium period. This seems like a game changer for insurers.
So it's a major one, mandated by the IRDAI. After a policyholder has continuous coverage for 8 years, the policy hits this moratorium. After that point, a claim can't be denied for a pre-existing disease that wasn't disclosed.
Except for outright fraud.
Except for established willful fraud, yes. But otherwise, 8 years is the line in the sand. It forces insurers to reprice their entire long-term health portfolio. They have to assume that after 8 years, everyone is a full-risk policyholder.
And quickly, who's actually required to buy public liability insurance? There's a specific trigger.
There is. It's mandatory for any unit that handles hazardous substances, but only if that unit has a paid-up capital of more than 25 lakh. It's a strategic way to target the companies that pose the biggest financial risk to the public.
Here's where it gets really interesting, because the law always trumps the fine print when public safety's on the line.
It does. Whether it's forcing an insurer to pay a victim first or absorb unseen health risks after 8 years, the regulator is setting a floor for social responsibility. The insurance company becomes the public's first line of defense.
So we've seen the contract rules and the legal burdens. Now, how do these massive companies actually afford all this? This takes us into reinsurance and solvency.
Right. This is the core financial architecture. Reinsurance is how an insurer shares its biggest risks, and we need to distinguish between the automatic kind and the one-off approach.
Treaty reinsurance is the automatic one. What about facultative reinsurance?
Facultative is negotiated on a case-by-case basis. It's like a special order. The insurance company can offer up a single, complex, risk like insuring a satellite launch, and the reinsurer is free to say yes or no. It's very flexible, but it's not guaranteed cover.
And for the really big black swan events, they use an excess of loss or XOL treaty. What's its main job?
XOL is all about protecting the company's balance sheet from the high severity of a single claim. It's not about how many claims there are, it's about how big one can get. It only kicks in when a loss goes above a huge preset deductible.
And if an XOL treaty gets used, the company has to pay to restore that protection, right? A reinstatement premium.
Yes, and it's not a flat fee. It's calculated based on the portion of the limit they used up and how much time's left on the treaty. So the cost of restoring the safety net is also shared.
These safety nets are all about solvency. What's the number, the red line, that tells the regulator a company is in trouble?
The magic number is a solvency ratio of 1.25. If a general insurer's ratio falls below that, the IRDAI immediately demands a corrective action plan, or a CAP. It's the regulator saying, your financial buffer is too thin, fix it now.
A huge crisis signal. And to help them stay above that line, the law tells them where they have to park their money.
Absolutely. To make sure they're stable and liquid, general insurers have to invest a minimum of 30% of their total funds in government securities or other super safe approved investments. That 30% rule is a bedrock of stability for the whole market.
And finally, let's talk profit. How do we measure it with a combined ratio?
The combined ratio, or CR, is just the sum of claims paid out plus all the expenses of running the business. If your CR is, say, 98.5%, like in our example, it means for every rupee of premium you collected, you spent 98.5 paisa.
And that little 1.5 pisa left over is your underwriting profit.
That's your underwriting profit. If the CR goes over 100, you're losing money on your core business and just hoping your investments make up for it.
If we connect this to the bigger picture, all these things, the XOL treaties, the 1.25 trigger, the 30% investment rule, they're all connected.
They are. They're designed by the regulator to stop one company's bad underwriting or one single catastrophe from causing a systemic collapse. It's structural risk prevention.
So for our final segment, let's look inward, at the rules for the people who manage all this risk. The internal HR and ethics rules.
Yes, and they're defined by extreme clarity, especially the conduct, discipline, and appeal, or CDA rules. Let's look at how management handles internal penalties.
Okay, the difference between a minor and a major penalty can make or break a career. So if an officer's increment is withheld without cumulative effect, what is that?
That is officially a minor penalty. Without cumulative effect means they lose that pay raise for a set time, but then their salary track goes back to normal as if it never happened. It's a financial slap on the wrist, not a permanent career setback like a demotion would be.
And what about vigilance cases? If an officer is suspended, they can't just be left in limbo forever.
No, there's a strict deadline. The maximum time for a review of an officer's suspension is 90 days from when the order was issued. It forces management to make a decision and prevents, indefinite punishment without action.
Got it. And let's cover the absolute hard numbers for employee benefits.
Okay, two key ones. The maximum statutory gratuity that can be paid under the Act is capped at 20 lakh. That's a non-negotiable legal ceiling.
And cashing out vacation time at retirement?
The maximum earned leave you can encash is 300 days. These are fixed compliance numbers that every finance department has to build into their liability planning.
We've talked a lot about external risk. What about the threat from within? Employee fraud.
For that, you have the Fidelity Guarantee, or FG policy. It's specifically designed to protect the company from losses caused by the fraudulent and dishonest acts of an identifiable employee. It's your financial shield against embezzlement and internal theft.
So what does this all mean?
I think it means that top-level insurance management operates on a razor's edge that's defined by these absolute numbers. We've seen that you have to master everything from the math of a proportional loss, like that 16 lakh claim.
To the hard financial triggers, like the 1.25 solvency ratio, it's about precision at every single level.
Exactly. You have to be an ambidextrous manager. One hand is signing contracts based on super specific clauses like the pair and set rule, and the other is navigating absolute laws like the pay first, recover later rule.
To wrap up, let's leave you with one final thought. Consider the Indian terrorism pool mechanism. This pools together risk for massive corporate and industrial assets all across the country.
Now, despite the staggering potential value of those assets, the maximum deductible the insured has to pay for any single loss is capped.
And the cap is surprisingly low.
It's strictly capped at 10 lakh. Think about that. Why does the mandatory local liability stop at this one relatively small figure, whether the factory is worth 100 crores or more? What does that cap tell us about who really bears the ultimate burden when the stakes are at their highest? Is it the individual company, or is it the pooled financial safety net of the entire country? That's the real question at the heart of systemic risk management.